Welcome back to the Deep Dive. Today, we are putting on our strategic analyst hats.
We are.
We're diving deep into the mindset of a major industry leader, Allstate CEO Tom. And this isn't just about reading the financial reports.
No, not at all.
It's about understanding the long-term strategic map, the vision that drove their huge Q3 2025 results and what they're planning to do next.
That's the mission exactly. We're actually setting aside the CFO's specific breakdowns and the Q&A.
Right.
We are focusing exclusively on the CEO's opening remarks because that's really the strategic thesis. He laid out a very clear sort of two-pronged approach for creating shareholder value.
And what were those two prongs?
First, dominating the personal property liability market through aggressive growth, and second, at the same time, expanding the kinds of protection they offer their customers.
So we really need to dissect the operational machinery behind those goals. Okay, let's unpack this with some real substance. We had to start with the Q3 score, right? Because the sheer scale and profitability of these results are what justify the highly ambitious strategy he presents later.
You have to. When you look at the Q3 2025 operating numbers, they speak volumes. Revenues climbed to $17.3 billion.
$17.3 billion.
And policies in force grew to 29.5 million. And that policy growth, that's the evidence that their strategy to expand protection is already working.
And the profitability is it's extraordinary. Net income hit $3.7 billion, which adjusted down to $3 billion, or 11.17 cents per share.
Which is huge.
But the number that truly defines their financial health and their confidence, particularly for an investor, is the return on equity.
Absolutely. For the last 12 months, that figure stood at 34.7%.
34.7%.
And just to contextualize that for you, a 34.7% ROE is not just excellent, it is phenomenal in the property and casualty insurance sector.
Right, because you usually see, high teens?
High teens, maybe low 20s, and that's considered great performance. So the CEO credited this to 4 primary factors, showing it wasn't just a fluke.
Okay.
Strong core property liability performance, crucially low catastrophe losses in the quarter, which, helps any insurer, and then 2 financial maneuvers. Higher investment income and favorable insurance reserve releases.
Okay, hold on. Let's quickly define that last piece of jargon. Favorable insurance reserve releases. It sounds like pure accounting magic. What does that actually mean for the listener?
It does, but it's essentially a positive adjustment to past assumptions. Insurers have to set aside reserves money they predict they'll need for future claims.
Good.
A favorable release just means they realize that they'd previously set aside too much for some older claims, so that surplus money can now be released back to the income statement as profit.
So it's a boost to earnings,
right,
basically showing the past was less costly than they thought.
Exactly.
That's great context.
Yeah.
So those 4 drivers, operational strength, low cat losses, solid investments, and these reserve releases, they built the momentum.
Right. And the CEO then distilled this into 4 ongoing strategic levers.
Which were?
Operational excellence, the transformative growth initiative, enterprise risk and return management, and substantial capital generation.
And I want to dig into that third one for a second.
Yeah.
Enterprise risk management. It sounds a bit like generic business school jargon.
It does, but in the insurance world, it's vital. It's all about managing the how and where they invest their premiums, especially in volatile markets, to maximize returns without taking on unnecessary risks.
So leveraging their huge investment portfolio efficiently.
You got it. And these 4 pillars, they set the groundwork for the biggest operational story they told, which is transformative growth.
Absolutely. The financial strength is clear. But achieving that kind of expense control and distribution expansion required some major internal plumbing changes, right?
Oh, massive.
Which brings us directly to transformative growth, or TG. The CEO is careful to point out this is not a new idea.
No, it's 6 years old and now fully mature, rolling out its final phase, which is a whole new technology ecosystem.
So TG is the primary engine, and its goal is to increase their property liability market share while, and this is critical, maintaining their margins.
Right, and this is the classic business paradox. You want to grow fast, but growth usually means you have to drop prices, and that eats into your profits.
That's the natural push-pull. So how does the CEO claim they managed to expand their share without sacrificing margin? The cost reduction answer seems almost too simple.
That's where the numbers really become the insight. They solved that paradox through massive, sustained operational cost reduction.
Yeah.
That allowed them to redirect all that saved capital into pricing flexibility and customer value. The concrete proof point he offered was a 6.7-point reduction in their expense ratio.
6.7 points. That sounds revolutionary in a highly mature industry like insurance.
It is genuinely massive. For those unfamiliar, the expense ratio is simply the cost of running the business, salaries, marketing, IT, commissions, divided by the premiums you earn. A 6.7-point reduction for a company the size of Allstate translates to billions in unlocked capital over the long term. And this flexibility lets them offer really competitive pricing to gain market share without hurting their profit goals.
So that reduction is what essentially fuels the second core element of transformative growth. Distribution expansion.
Correct. The CEO knows they can't just rely on their historical model for future growth. Historically, they were known for their captive agents.
Agents who only sell Allstate products.
Exactly. They needed to successfully integrate the independent agent, channel agents who sell products from multiple carriers. And that transition is, well, it's historically very challenging for insurers.
And the source material shows they've pretty much pulled it off. The company's auto insurance distribution is now almost perfectly balanced across 3 channels.
It's really impressive. 1/3 via Allstate agents, 1/3 via independent agents,
and 1/3 direct to the consumer.
And the key takeaway from the CEO here is that they didn't get this balance by letting one channel shrink. He said that all 3 channels have actually increased their volume.
Which validates the 6 years of investment.
It validates everything. All the work on flexible pricing and underwriting systems needed to support that independent network.
And beyond the plumbing of distribution, they tied this growth directly to better customer value. The specifics here are important. They cited improved outcomes in over 46 million customer interactions this year.
Right.
What does that mean in practical terms?
It means they're focused on all the little friction points that cause customers to switch insurers. It's things like faster claim processing, clearer policy language, easier websites, and resolving billing issues quickly.
Okay, so the day-to-day stuff.
Exactly. And that massive expense reduction gave them the room to invest in products that truly save customers money, like the Save-E program.
Yes, the Save-E program. That's a really relatable consumer detail.
It's a powerful retention tool. They helped over 5 million auto and home customers actively reduce their premiums by more than 5%.
Well, this isn't just a discount.
No, it's a sophisticated application of data and pricing technology to reward and retain their existing customers by giving them tangible value. And this level of sophistication, reducing costs, balancing distribution, delivering high-value programs, is why the CEO then pivoted to the tech underpinning it all. Applied AI.
That's our entry point into the future. They built the transformative growth architecture, and now they are injecting advanced technology right into it. The CEO's analogy for generative AI was fantastic.
It was great.
He compared it to Ted's sneakers commercial. Gen AI makes you run faster and jump higher.
Meaning Gen AI is being implemented today primarily as an efficiency multiplier. It turbocharges existing tasks without necessarily changing the fundamental business model yet.
It's operational horsepower.
It's making everything faster and cheaper right now.
So what are the immediate concrete uses of Gen AI that they said are currently adding value?
They gave several powerful examples. On the customer service side, Gen AI is simplifying and clarifying billing explanations.
Oh, that's a good one.
Think about how frustrating insurance statements can be. By making them instantly understandable, they dramatically cut down on the number of follow-up calls from customers.
Sure.
In claims operations, there's an even deeper integration. All adjuster emails are either generated or reviewed by AI for clarity, compliance, and speed.
Reviewing every single email in the claims department. That is a profound commitment to AI integration.
It is. And internally, 15% of their software coding is now being performed by AI agents.
Wow.
They're also using Gen AI in actuarial and financial work, which lets them accelerate their go-to-market strategies, getting new products priced and out the door quicker, and it further reduces costs.
So all of this is about immediate and effectiveness.
It is.
But the CEO clearly signaled that this is just the warm-up act. He distinguished this immediate Gen AI utility from the next frontier of advanced AI, which he said holds even greater promise.
And this is where the strategy shifts from efficiency to reimagining the core business. The next frontier is about using advanced reasoning AI to restructure how they offer value to the customer. Everything from how they communicate to how they settle claims.
And this future is centered around their proprietary large language intelligent ecosystem, which they call Ally.
Yes, Ally. And the strategic decision to personify their AI ecosystem is, I think, highly revealing. The CEO explicitly stated that they view these intelligent agents like employees.
Like employees.
Because they're capable of reasoning, resolving tasks from end to end, and interacting with the customer autonomously.
That implies an enormous level of confidence. When you call an AI agent an employee, you're trusting it with your reputation, with your customer experience.
Exactly. You should think of Allstate not just as a piece of software or a chatbot, but as the most efficient, tireless new employee who can handle complex claims, underwriting adjustments, and customer communications 24/7.
And this kind of sophisticated task delegation, it lowers costs while simultaneously improving customer outcomes because the AI can access and analyze every piece of data instantly.
That's the idea.
So if we summarize the CEO's opening thesis, we have a very clear picture of how they plan to dominate the market.
It is a two-part engine, really. Immediate financial success and funding for growth, that's all driven by the mature execution of transformative growth.
Right, the expense reduction and the tri-channel distribution.
Exactly. And then future dominance and the expansion of what they call protection offerings, that is anchored in the aggressive adoption of advanced reasoning AI, which they're calling Ally.
So TG built the strong financial foundation and the tech architecture necessary to make this AI future even possible.
It paved the way.
If we connect this strategy back to the bigger picture for you, the listener, the CEO's presentation is arguing that technological sophistication is the key to achieving what has, always been impossible in insurance, delivering lower prices and radically better service at the same time.
It suggests the competitive differentiator moving forward isn't who has the best ad campaign. It's who has the most sophisticated AI ecosystem. This technology, exemplified by Ally, is meant to be the core reason they can continue to grow market share and maintain profitability. It will radically change how you interact with your insurer in the coming years.
Which leads us to a final provocative thought, and this is based on the CEO's specific ambition. He suggested that AI will enable the company to add things that we don't currently do because they're too expensive.
Right.
So if a high-functioning, cost-lowering AI employee like Ally is managing the expense ratio, what surprising new forms of protection outside of just traditional auto and home coverage might an insurer start offering you that are currently just too costly or too labor-intensive or, frankly, too complex for humans to manage?
That is something to chew on.
Something to chew on as the industry continues to evolve around AI.